There is a silent mismatch happening in millions of households right now. The economy has shifted, rapidly, structurally, and globally. But personal financial strategies have remained stuck in an outdated playbook. Many people are still making decisions based on assumptions that were true 20 or 30 years ago. They are budgeting, saving, investing, borrowing, and planning retirement according to rules that applied to a different era. The result? Increasing stress, slower wealth growth, rising vulnerability, and confusion about why hard work no longer produces the same results it once did. The economy changed, but if your strategy didn't, you are playing today's game with yesterday's rules. Today, we will talk about the economy changed, but your strategy didn't. So, before we start, make sure to hit the like button and subscribe to my channel. One of the biggest economic shifts is inflation volatility. For many years, inflation remained relatively predictable. Recently, global events, supply chain disruptions, energy market fluctuations, and monetary stimulus policies have caused rapid price increases. Groceries, housing, insurance, healthcare, and transportation costs have risen significantly. Yet many financial strategies still assume stable pricing. If your savings are sitting in low-yield accounts while living costs climb, your strategy is misaligned with economic reality. You may believe you are being conservative, but in practice, your purchasing power is shrinking year after year. Interest rates have also changed dramatically. In low-rate environments, borrowing felt inexpensive. Mortgages were affordable. Refinancing was common. Credit expansion accelerated. Now, higher interest rates increase the cost of debt. If your strategy still depends on cheap borrowing or high leverage, you may feel pressure. Adjustable rate loans, credit card balances, and new financing carry heavier costs. A modern strategy requires evaluating debt exposure more carefully, prioritizing principal reduction, and avoiding unnecessary leverage that was once easier to manage. The labor market has transformed. Job stability is no longer guaranteed by tenure. Automation, artificial intelligence, and global competition are reshaping industries. Remote work has expanded opportunities but increased competition across geographic borders. Yet many individuals still rely entirely on a single employer for income security. In a rapidly evolving job market, income diversification is no longer optional. It is strategic necessity. Side businesses, consulting, digital products, freelance services, and investment income create buffers against employment shocks. Technology has redefined access to income and investment. Online platforms allow individuals to launch businesses, invest globally, and monetize skills at low cost. If your strategy still assumes income only comes from a traditional 9-to-5 job, you may be limiting your potential. The modern economy rewards adaptability, scalability, and digital literacy. Those who leverage technology increase efficiency and earning power. Another major shift is retirement responsibility. Previous generations often relied on defined benefit pensions. Today, retirement planning rests primarily on individual shoulders. 401s, aka IRAs, brokerage accounts, and self-managed portfolios require active attention. Passive participation without understanding asset allocation, contribution rates, risk tolerance, and withdrawal strategies can result in shortfalls. Simply contributing occasionally is no longer enough. Intentional retirement design is required. Now consider Social Security. Many individuals continue to assume Social Security will provide sufficient retirement income. However, Social Security was designed to supplement, not fully replace, working income. Benefits depend on lifetime earnings and the age at which you begin collecting them. Claiming early reduces monthly payments. Delaying can increase them. Without careful planning, you may either underutilize benefits or rely too heavily on them. A modern retirement strategy integrates Social Security with diversified investments, healthcare planning, inflation assumptions, and longevity projections. Housing markets illustrate another shift. In many regions, property values have risen faster than wages. Homeownership may still be beneficial, but affordability challenges require careful evaluation. Assuming real estate will always appreciate rapidly is no longer safe. Markets fluctuate. Property taxes increase. Insurance premiums rise. Maintenance costs compound. A strategy built solely on property appreciation may not deliver expected results. Diversification across multiple asset classes reduces concentration risk. Global interconnectedness has increased economic sensitivity. Events in one region impact markets worldwide. Currency fluctuations influence imports and exports. Geopolitical tensions affect energy prices and supply chains. If your financial planning ignores global dynamics, you may be unprepared for ripple effects that influence your portfolio, job stability, or cost of living. Healthcare costs are another evolving factor. Medical expenses continue rising, especially for aging populations. Retirement planning must account for long-term care, insurance premiums, prescription costs, and potential chronic conditions. A strategy that overlooks healthcare inflation risks depleting savings prematurely. Health events are not rare exceptions. They are statistical probabilities over a lifetime. Education and skill relevance are shifting rapidly. Degrees alone may no longer guarantee stable income. Continuous learning has become essential. If your earning strategy relies on outdated skills without reinvestment in learning, income growth may plateau. Professional stagnation often translates into financial stagnation. Debt culture has expanded significantly. Buy now, pay later services, credit cards, student loans, auto financing, and subscription-based spending models normalize ongoing obligations. If your strategy does not aggressively manage high-interest debt, compounding interest works against you rather than for you. Debt that once seemed manageable becomes restrictive when rates rise or income fluctuates. Emergency preparedness has become central to resilience. Economic shocks, pandemics, layoffs, and unexpected repairs demonstrate the importance of liquidity. A strategy without an emergency fund is fragile. Even strong investment portfolios can be forced into premature liquidation if liquidity is absent. Another overlooked shift is psychological. The information age accelerates emotional reactions to financial news. Market downturns trigger panic selling. Social media comparison fuels overspending. Headlines amplify fear. If your strategy lacks discipline and structure, emotions may drive decisions. A written financial plan anchored in long-term goals reduces impulsive reactions. Tax environments are evolving as governments adjust policies to manage fiscal pressures. Understanding tax-advantaged retirement accounts, deductions, capital gains strategies, and legal optimization techniques has become increasingly important. Tax inefficiency can quietly reduce long-term returns. Demographic changes also matter. Aging populations affect pension sustainability and labor supply. Younger generations face higher housing and education costs than prior generations did at similar ages. Strategies must adapt to these demographic realities rather than assume historical patterns will repeat. Climate change and sustainability initiatives are influencing capital flows. Renewable energy investments, green technologies, and environmental regulations shape future industries. Investors who ignore structural transitions may miss long-term growth trends. Consumer behavior has also shifted. The digital economy encourages instant gratification. One-click purchases, fast shipping, subscription models. Without intentional spending control, financial leakage increases. Convenience often comes with hidden cumulative costs. The economy changed. Interest rates shifted. Technology advanced. Demographics evolved. Costs increased. Competition expanded. If your strategy remains unchanged, you are navigating a new world with outdated assumptions. Financial resilience is not about predicting the future perfectly. It is about adapting consistently, reviewing regularly, and acting intentionally. Update your strategy before the mismatch becomes expensive. Because in a changing economy, flexibility is not optional. It is survival. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.